Welcome to OLevels Economics Unit 16, Money and Banking. Money exists in several forms, including coins, banknotes, and bank deposits. Coins are mainly used for small transactions, while banknotes are used for larger purchases. However, the most important form of money in modern economies is bank deposits, as they account for the largest value of transactions. Money can be transferred between bank accounts through direct debits, debit and credit cards, online banking, and mobile phone payments. Although bank deposits are not legal tender, they are widely accepted because they are convenient. Legal tender refers to a form of payment that must be accepted by law in settlement of a debt, such as banknotes and coins up to a certain value. Money performs four essential functions. It acts as a medium of exchange, allowing people to buy and sell goods and services without relying on barter. It also serves as a store of value, meaning it can be saved for future use without losing its usefulness over time. Money functions as a unit of account by providing a common measure of value, allowing prices to be expressed and compared easily. Finally, money acts as a standard of deferred payments, making it possible for people to borrow and lend by agreeing on repayments to be made in the future. For an item to function effectively as money, it must have certain characteristics. It does not need intrinsic value, but it must be generally acceptable, so that people are willing to use it in exchange. To maintain acceptability, money must be in limited supply. It should also be durable, portable, divisible into different values, homogeneous so that units of the same value are identical and easily recognizable. Banking is a vital industry that supports economic activity by helping people and businesses borrow, save, and make payments. Commercial banks, also known as retail or high street banks, are profit-making institutions that provide banking services to the public. Their traditional functions include accepting deposits, lending money, and enabling payments. Deposits are held in current accounts, which allow easy access but usually earn no interest, and deposit or time accounts, which pay interest but may require notice before withdrawal. Commercial banks lend money mainly through overdrafts and loans. An overdraft allows a customer to spend more than their account balance up to an agreed limit, and is usually used for short-term borrowing at relatively high interest rates. Loans are typically provided for specific purposes and periods and often involve lower interest rates. Banks may require collateral to reduce the risk of non-repayment. By accepting deposits from savers and lending to borrowers, banks act as financial intermediaries, earning profit from the difference between the interest they charge and the interest they pay. In addition to their main roles, commercial banks offer a range of other services. These include foreign currency exchange, safe storage of valuables, financial advice, insurance products, mortgage loans, and assistance with investments and tax matters. While their main aim is to make a profit, banks must also ensure liquidity by keeping enough liquid assets to meet customers' withdrawal demands, balancing safety with profitability. In some countries, particularly Islamic economies, charging interest is not allowed as it is considered sinful. Instead, Islamic banks provide finance through profit-sharing arrangements. Many international banks operating in Islamic countries now offer Sharia-compliant financial products under the guidance of Islamic scholars. Central banks are the most important financial institutions in an economy and are owned by governments. They act as bankers to governments and commercial banks, issue banknotes, manage the national debt, hold reserves of foreign currency and gold, regulate the banking system, and implement monetary policy. Their main objective is to maintain price stability by controlling inflation through managing interest rates and the money supply. In many countries, central banks are given independence to set interest rates, while governments set inflation targets. This independence helps ensure that interest rate decisions are based on economic conditions rather than political pressure. As a result, independent central banks are often more effective in maintaining economic stability and controlling inflation. Thanks for watching.